session chair and hand over the proceedings to him. Our session chair is Mr. Srivatsa Krishna, IAS and ex-World Bank. A very brief profile of some of his noteworthy accomplishments. Srivatsa Krishna topped India, the first rank in about 500,000 candidates in the civil services examination in 1994 and joined the IAS. He was awarded the President's Gold Medal for topping the country in the civil services. Thereafter, he was a member of Andhra Pradesh Core Government IT and Infrastructure team. Mr. Srivatsa Krishna has also been part of the leadership team, which was created one of Asia's largest IT and investment clusters, and there has been globally acclaimed people such as Goldman Sachs, Business Week, Economist, and Time as a marvel of modern India. In 2009, he led a study commissioned by the highest levels of the Government of India on public-private partnerships and related private equity and investments policy for the country on behalf of IFC, the World Bank Group. He went on to become the first serving IAS officer in India to complete the prestigious MBA program from the Harvard Business School. The World Economic Forum at Davos honored him as one of its top 100 global leaders for tomorrow in 2003 for his accomplishments. More recently, in the Strategy, Finance and Risk Management Vice Presidency at the World Bank, Washington, D.C., he was co-heading Investing World Bank's annual capital portfolio of about $2 billion into financial services, energy, health, infrastructure, IT, and various consumer-facing businesses. I think you're better for the nation there. Srivatsa has also sung a playback for Shanghai, a Bollywood production about an IAS officer's life, whose main protagonist's character is inspired by his own life. With this, I'd like to hand over the proceedings to Srivatsa, please.
Thank you, Vineet. Ladies and gentlemen, it's a great privilege and honor to chair this panel. I don't know how many of you remember the motion picture called Sholay, which was released in 1975. The tagline of Sholay said, "The greatest star cast ever assembled and the greatest story ever told." I have assembled the greatest star cast of private equity superstars in India on this panel today. And hopefully all of us together will tell you the greatest story that you wish to hear. Let me start by introducing the panel. K.P.Balaraj, Managing Director of WestBridge Capital. Vijay Pattabhiraman, Managing Director, JP Morgan Asia. Akhil Gupta, Chairman, Blackstone Advisors India. Sandeep Naik, who I'm personally grateful to for having accepted this invitation at very short notice. Managing Director of General Atlantic India. Ashish, Dhawan, Chairman, ChrysCapital. And Neeraj, Bharadwaj, Managing Director, Carlyle, India. Ladies and gentlemen, we hope during the course of the next 90 minutes, we give you a thoughtful, insightful, and hopefully a fun panel. I want to start by asking the question. The title of the panel is No Quantum, Little Solace, Retrospect and Prospects for the Indian Private Equity Industry. So I'm going to start the panel with brief opening comments from every panelist on where they think the private equity industry in India is today and where they see the future as. Let me start with Neeraj. Neeraj, what are your thoughts on this?
Firstly, when we talk about the star cast, it's very unusual to have an IAS officer as a moderator. So I think the threshold on truth here is going to be a lot higher than it will otherwise be. In that context, I think the Indian private equity story, if you look at the rearview mirror, hasn't been the greatest. Returns haven't been, for most funds, haven't been, except for the gentleman here. Only one of us on this panel is retired, and so you can sort of figure out where the returns have gravitated. But returns in general for most funds haven't been that positive. I think people have had one-off exits, but at a fund level, performance has not been that great. And I think that's been driven by, as you put in your article, I guess, last week in Economic Times, given there's a public market, which is a benchmark for valuations, even valuations on the private equity side have historically been very high relative to growth and relative to return on capital. And I think secondly, in India, promoters or entrepreneurs, founder managers have been averse to taking private equity money. It's still a very new category in India. The history of this private equity in India is only 10 years at best, more likely sort of 7 years from when it's gained scale. But I see that changing now. I feel we're at a watershed moment right now. volatility in the public markets has made fundraising difficult, at least at the large check size from the market. So you see many more deals of size with reasonable valuations in private equity. I think secondly, promoters have an increasing awareness of the value they can get from a private equity fund, how people can help with strategy, operations, as well as the network one brings to the table. And private equity firms also have an understanding of how you can work with Indian promoters. And I think lastly, a very interesting trend in India is that you're seeing many more buyouts happening in this market. You see multinationals which are looking to divest India businesses. You see first-generation promoters who are willing to let go of their businesses, not necessarily cede it to the next generation. So I see those as positive trends for private equity. And I think private equity 2.0, the term you've coined, I think will be a lot more positive than 1.0.
Thanks, Neeraj. Ashish, since he's already put you on the spot, you're the only one who's retired and probably retired because you made too much money. What are your thoughts on India's private equity industry when you look back and look ahead?
Yeah, so clearly, I mean, the golden period was 2002 to 2007. We were lucky to be there at that point in time. And it's been really tough after that. I think given the amount of capital that was raised, my view was always that it would be 7, 8 years before you would hit the next sort of point inflection point when it would turn attractive again. I think we're coming close to that point now when it's still not, I mean, it's still a fairly crowded market. There's lots of players, paucity of deals. I agree that there's a higher proportion of buyouts, but it's still largely a minority market. So my sense is the tide will start to turn, and it's going to be better during the back half of this decade. I think the one thing that has bothered me, the 13 years that I was actively involved in private equity in India, is I didn't see any improvement in corporate governance at all. In fact, it may have actually declined for a period of time when lots of money was readily available. So I think that tide needs to turn, because if minority investing has to be successful, then corporate governance really has to be improved. You know, I think the regulators are trying to take some small steps, but we need much larger steps to be taken on that front. There's a SEBI consultative paper that's out that talks about minority investors or non-promoter investors being able to elect independent directors. I know promoters don't like it, but I think that would be a first very healthy, good step so that minority investors, not just private equity, but FIIs as well in listed companies, have significantly more rights vis-a-vis the promoter. So that's the one thing that I'm really looking for, is improvement in corporate governance.
Let me turn to you, Akhil. You head the world's largest private equity fund in India. You also, before that, had a stellar career with India's foremost corporate house, Reliance. From your perspective, how do you look at private equity in India from your own experience, looking in the rearview mirror as well as looking ahead?
So I think it depends if you look at a static view or a dynamic view. And I think that'll mirror what you think of a static view of India as well as a view of India, whether you look at today's India or the future. So clearly all of us came for growth because India offers the kind of growth in an environment which very few countries in the world can offer. Such a large economy. It's a once in a lifetime kind of thing. I think to that vision I remain still committed and I still have faith. So now what one of the comments my chairman made once is be very apt, and he says, Akhil, the most prudent assumptions that you ever made about India have turned out to be widely optimistic. So I think that's what, I don't think the story of private equity has changed. I think it remains very, very solid. Let's not forget we had two major crises. We had one global financial crisis, and I think all of us portfolio has been affected by that. And worse still is, we have disappointed the world in terms of the way we have managed our economy for the last 2 years. So we had the governance crisis in India. So my view is, if we had portfolios where you chose the right promoters, I still think you'll do well. Probably instead of 5 years, it'll take you 7 years. We'll do well. But let me give you a perspective that, since you asked me what I felt last 7 years, I've been feeling like when I went to business school at Stanford, right in the Silicon Valley, so you were really constantly meeting, the entrepreneurs. And it really reminds me the role that these venture capitalists played in, ushering US on top of the IT revolution and biotech revolution, and now, they're talking about nanotechnology, clean water technology, and social media. I think we have to play the same role, and it's just not the money that they gave. It's the guidance, the network they provide, the governance they brought in. I find exactly the same role that I'm playing now, and that's why I love it. The value that you can add to Neeraj's point in terms of just holding hand, because the opportunity with all the promoters is much way beyond they ever imagined 5 years back. So that opportunity still exists. Probably we have to be a little patient. We have to, India's story is 3 steps forward, 2 steps back, and hopefully we're hoping that instead of 3 steps forward, 2 steps will be only 1 step back, but we have taken probably 2.5 steps back. But I think that'll change, and it'll change, as Mukesh Ambani said the other day, the billion people's aspiration is going to drive the country's growth.
And every one of the billion count.
Exactly, and I really believe that I think we will have no other option but to realize the potential of India. We are a per capita economy for only $1,500 per person. And there's no reason, just if we don't screw it up, sorry to use that word, but if you don't mess it up, then we should be growing at 8 to 9% a year, which we had grown from 2004 to 2009-10. So that's my perspective, that if I take a dynamic view, then I remains bullish. And we are continuing to be very pleased with our portfolio. Last year we committed another $300 million in real estate, another $300 million private equity. So in spite of the disappointing Indian background, we actually remain pretty committed and working very hard.
KP, you didn't go to Stanford. You went to God's own business school, Harvard.
Sure.
And I read Clay Christensen on the private equity industry recently saying that the industry is getting disrupted. All the bigger players are chasing bigger and bigger investments, whereas the middle of the market and the lower end of the market is actually wide open and very few funds are going in. Your thoughts, please.
Yeah. First on the initial question, I think sort of my own view is looking at where we are today and looking forward, I'm actually quite positive and hopeful, because most of the sins of the past or most of the constraints and challenges that the industry has faced are well known to everyone. I think there's a huge focus on more reasonable valuations, which was the single biggest driver of getting exits to be difficult. So I think going forward, I think both at the investor level as well as the entrepreneur level, there's a focus on let's look at a reasonable deal, let's look at a sort of win-win partnership for both sides. I think that culture, unfortunately, was not the case for most of the past. So that's one. Second, I think India is in a very different situation relative to many of the markets elsewhere, especially the US. It remains fundamentally a growth-oriented market. So if you look at many of the biggest funds in India, they also are very active growth equity investors, because over time the buyout market will happen. But these are very large funds. They have substantial experience. They have lots of learnings from other parts of the world, and they're applying that to India. So I think looking back, the negative news is well known. The headlines are well known. At the industry level, relative to expectations, when investors first came in, because of the growth, I think folks were hopeful that India could be a 3x type market at the fund level because of high growth, very high quality of entrepreneurs, good businesses. But for a number of reasons, whether it was valuation, Ashish mentioned corporate governance, that has not panned out to be the case. But even in spite of a very difficult environment, Akhil mentioned, we've been through 2 very drastic periods. In spite of that, there are a number of groups that have performed and have returned good capital to investors. So I think on the investor side, meaning investors who invest in funds, there is still excitement. They want to be in India. My own view is the next 5-10 years, you will see private equity booming in the country, but it'll be a different kind of boom. I think on the local side, it'll probably be smaller, more focused funds. Maybe you'll have funds that are only focused on South India. Maybe you'll have funds that are only focused on mid-market business in healthcare or consumer. And then you'll have very large global franchises, the Blackstones, the Carlyles, the Sequoias, who build a far more diversified pool. But for the vast majority of the industry, people who are building their careers in private equity or are working in many of these firms, looking at the next cycle of becoming either a venture or private equity entrepreneur, I personally am quite bullish.
Vijay, you're the only one on the panel who invests across Asia, unlike all the others who invest in India. And also, I think you're the only infrastructure investor on this panel. I'd love to have your thoughts on how you view India's private equity, both past and the future.
Sure. But I'm not the only infrastructure guys, because most of these guys, I think, when they want to do big deals, especially him, he's done plenty of infrastructure too. But yeah, we are specialists in terms of infrastructure and related industries, hard assets, cement, steel. My take in terms of the past, 2002 to 07, I agree with Ashish. In this kind of a market, wherever you invest, you're going to make money because the market will take you out, right? So we didn't have the discipline to do fundamental, as an investor community, right? Many of us, I'm not necessarily going to say all of us, but many of us didn't have the discipline to do fundamental analysis of whether this value does make sense, what is the operational improvements we're going to be looking at post investments, right? So, because the market would take you out. Now, post 2008, we all have to work a lot harder. One, to find good deals. Good deals are where the sponsor is good, your partner is good, which is 60% of the game. But the other 40% is you need to have a good business model, right? And today, and again, like I said, a lot of us in this business probably are responsible for it. You don't see the right kind of emphasis on that discipline, right? Second is corporate governance, as well as, more important, the government, the policies, and you know
it would come back to us somewhere or the other.
No, but you're aware of some of the issues which I'm talking about. It's been awful. They've been so much, honestly. And this is supposed to be an honest forum. So I'm going to take a leap here.
Please be as frank as you want.
All right. No, there's been way too much arrogance, right? I think way too much arrogance in the government, right? In the system. Whoever I speak to, they say, oh, the demographics will take us out. It's, I hear the same story. 1.2 billion people, I also use it when I have to raise money, right? But, how many times will you get 1.2 billion people to take you out? When execution is so poor, basic stuff, land acquisition, have consistent policies. If someone, signs an agreement with you, honor it, right? I'm saying when the counterparty is the government, right? So, but having said that, the fact that I'm sitting here, right, the fact that we have a big office here, we have quite a few investments here, means that we do have faith in this market. And I do see, opportunities. But it's going to be a different kind of private equity. It's not going to be lazy private equity anymore. This time around, people will actually have to work hard, right? Operationally, they'll have to take a lot of pains in terms of developing the right kind of deals. You can't have shop deals. Because otherwise, if you want to do a $200 million deal, most everybody will get to see it, including us.
Sandeep, turning to you. You've worked with two marquee, very well-known, highly respected private equity firms, Apex and now General Atlantic. How do you see the market?
Yeah, I think my job has been done easier because most of the comments have been made here. But I'm actually not surprised as to what's happened in the last 10 years. Because our industry is a very, very nascent industry. And in any new industry, we have to go through the changes that we did. So the period when Chris was very active and Ashish was very active was a great period because there was very low competition. Promoters were just trying to explore what private equity is, and you could actually create alpha by getting into those companies. Then came the 2007 to 2012 period, where there was a global financial crisis, there were governance issues in the country, there was a slew of private equity investors that entered the country, there were a lot of first-time funds being raised, and as a result, there was too much capital chasing too few deals, and there was lazy private equity that was happening. Because the view was that the markets will only go one way, and as a result, a floating tide rises all boats kind of a mentality. And there was a lot of top-down investments and not real fundamental bottom-up investment that was happening. And now we are hitting a period where people are looking at their portfolios, wondering why there haven't been many exits, and are actually spending time trying to create value in their portfolio companies, which is what true private equity is. So I think in this phase 3 of private equity that we see today is when we are seeing the industry mature, the people within the industry really maturing in terms of what creates value for the shareholders, for the company, for the promoters, and for themselves. And that's the phase that we're going to see unfold in the next 5 years. So I feel pretty optimistic that the industry is maturing to a point where now we know what true private equity is, where owners and promoters can then look at the breed of investors out there and say, listen, we want to select 5 out of the 50 out there because they really know what they're talking about. And experience is going to show off, and experience is also going to pay off. So I think that's where we are today. The other issues that have been discussed is, as a result of this discovery process, the promoters have now figured out what private equity means, and that it's just not another form of capital that's going to be passive. So they are much more educated that private equity is actually a form of capital that's going to bring value add, that's smart capital, and there will be questions that will be asked that he or she would be responsible for. The private equity guys have learned that what they do globally, which is predominantly buyouts, you just can't come here and dictate terms. You can never go into a promoter company and say, let me change out the CFO in the first 100 days. That's what you typically do globally. And so they have figured out what are the battles to pick and which is the highest impact opportunities that they can go after. So that is a learning for our industry. And the last thing which Ashish mentioned is governance, and that's a learning on both sides, where the owners of companies now know that proper governance is needed to attract the best capital, where the industry has learned that you just can't invest behind promoters and owners without doing the diligence on the governance aspect, because there have been few deals that have blown up. And that's a learning that we have jointly come to. So hopefully the next 5 to 10 years are going to be the true private equity era for India.
Thanks. I'm going to dig deeper into a few select issues, but before that I should share with the audience and thank CNBC who's televising this panel, and Outlook Business who are covering this panel as well. Let me pick a few select issues and throw them to people on the panel. Let's start with what Venture Intelligence has been talking about, the sponsors of this conference, about the exits overhand. 2,036 companies have been invested in the last 7 or 8 years by private equity, and there are over 700 plus companies who are yet to exit. Ashish, as someone who exited and exited very successfully, do you see a real exit overhang problems of funds, investments over 7, 8 years old, and many are saying 2013 is going to be the year of exits, the golden year of exits. Do you agree with that?
So first of all, I would contest the data. I don't think that there have been, you said 700 are left out of 20.
More than 700,
yeah,
700 plus.
It's much more. I would think that there's a huge overhang. It all depends on the market is the simple answer. The market is going to take you out, strategics in some cases. So I think it's purely a function of what happens to the Sensex, over the course of the next year. I don't think it's going to be a bang-up year. I think it'll be a better year than what it was in the past. But I don't think it's going to be a bang-up year because also private equity has been very concentrated in some sectors which the market doesn't like at all. And market's in love with financial services. Those are already public, most of the companies. With pharmaceuticals, almost all are public. There are very few private assets. And FMCG, which are all public already. The stuff that private equity money really is in, some of which is public, some of which is private, the market doesn't like it all. So I don't think it's going to be a great year for exits, is my view.
Okay, how about you? Your thoughts on exits in 2013 and exits in general?
Generally, I agree with what Ashish is saying. To our specific situation, we are bringing 2 companies to IPO, and they're not, one is a pharma company and one is an agricultural business company. And we have interest in by 2 strategic players and 2 other portfolio companies. So I think especially with Blackstone, probably it could be a good year for us, but you never know what will happen. But I think I'll give you another perspective on exits. As I said that I think we have had 2 crises, global financial crisis and then the governance crisis in India. So companies which should have matured for exit, which deals we did 5 years back, unfortunately, they're not ready in terms of exit valuation. So we can exit, but we don't want to exit at that point of time because we still see the future. Now, till today, it has not affected our ability to do more business, and probably it wouldn't have, but for the fact that the Indian sentiment has become, or had become so negative, that people are asking the question that how much money should we be locked into India when we don't see a clear path to exit. So I don't know how each one of us is getting affected. But if the sentiment does not improve, then that will hinder new capital coming into the country.
Neeraj, you exited one of your investments in part recently. What are your thoughts on this?
So I think, to give you a perspective, at a fund level, very few people have made money. As I said earlier, Chris made money, KP where you were before, Sequoia's made money. But otherwise, people have one-off investments. And so I think to Akhil's point, there is I wouldn't call it pressure, but there is, a certain question from LPs is, are there returns in India, right? India is you can't sell the demographic dividend story in India right now, 1 billion people. People saying, okay, that's fine, I heard that 5, 6 years ago, Are you telling me the same story? Is there some real money? Show me the money. So I think in that environment, exits are helpful, and that's, for us, HDFC was a big exit. It was the right time, but it's also sort of with a stake in the ground that India is a positive story for us. I think you'll see more. I wouldn't call it the year of the exits necessarily. I think you'll see more exits this year because, as Sandeep mentioned, there were a lot of first-time funds raised in 2007. A lot of people are under pressure to exit right now. It might not necessarily be great exits, but they need to show some return of capital to have any semblance of a chance of raising another fund. So I think you'll see more exits this year. I wouldn't call it the golden year by any stretch because there's volatility in the markets. The markets are not really deep. As Ashish said, some of the companies people invested are not really ready for prime time. But you'll see more exits, I think, sponsor-to-sponsor trades because the first-time funds do need to show some returns.
Sandeep, you wanted to share something?
Yeah, I think there's a slight mismatch in our industry today because if you think about the funds, funds invest probably in the first 5 years of their life cycle and harvest in the next 5. And if you think about all the deals that happened in 2005, 2006, now those are companies that should have exited by now for those funds to show the returns and go raise a subsequent fund, as Neeraj mentioned. Now, from General Atlantic's experience, and we've been in the market for over 11 years now, we have seen all the ups and downs and have done deals like Genpact and Putney, which returned a lot of capital. What we have realized is that India is not a 5-year hold market. It's probably a 7-year hold market. And for you to really get to your IRRs and cash returns, you might have to hold India slightly longer because there will be some ups and downs, either regulations or policies or something that will deviate your projections off course. And then it takes time for you to bring it back. On a 7-year hold, if that's when your returns actually get to the point that you want to exit, the fund life cycle and the fundraising life cycle, there's a bit of a mismatch. And as a result, people feel the pressure, A, to deploy when they raise a fund, and B, to exit so that they can raise a subsequent fund, which leads to a lot of the companies wanting to exit. So 2013 is one of those years where a lot of the companies will come up for exits, but they won't necessarily be bang-up exits. So they may not yield the kind of returns they expected, but they will be out in the market for an exit.
Okay, let's turn to a related issue, namely of corporate governance. People in the market, in the know, inside government, in the private equity industry are today talking openly about instances of serious corporate governance violations. There have been noted FCPA violations. The Enforcement Directorate is in the picture. The CBI is in the picture. Some firms have already received inquiries from government investigating agencies. So I want to focus a little bit on what's happening. And the question related I want to ask is this something good for the industry as a whole? Because many feel this is good. Those who are not serious investors will actually be exposed, and it'll, as a whole, be good for the industry. And also a related question is, are the larger funds, especially the well-known marquee funds, diluting their standards of corporate governance, diluting their standards in order to push out more capital into India? Let me start with Vijay.
Well, I don't have the problem that I have to invest in India. So one of the advantages of having a wider geography to invest in is that we don't have to push money into India, and we don't dilute our FCPA standards. And I don't think most of the large funds who are sitting out here, especially U.S. funds, would ever say that they would dilute the FCPA standards. But having said that, I think it is good for the industry. All these kind of noises and stuff is good, but there has to be a landing sometime, right? I mean, if we keep having noise for like tons of years, then all we are seeing, at least my limited interaction, is a lot of uncertainty, right? At government policy making, execution, and we don't see anything moving ahead, anything moving forward, right? So I'm all for this, and a lot of times we take very strong stands ourselves in many of our investments, but there has to be a landing.
KP, what do you feel?
It's tough.
Can you just pull up your mic?
Yeah. No, I guess there have been some cases that are being looked into, but my own view is, as a broad brush, it's very difficult to paint something as good or bad. And the reason I say that is on both sides. Investing in India is a very difficult business. We get asked this question a lot. There are notions that private equity and venture are easy places to make money. But there's a tremendous amount of effort and discipline that goes into both sides. So I think at the partnership stage, when an investment is made, my sense is, a vast majority of folks on both sides, intentions are good. Now, have there been one-off cases? Absolutely. Is that the beginning of a large, significant negative trend? My own view would be probably not.
Ashish, as someone who is retired from the industry officially, you can speak a little more frankly than the others and on this issue. Do you think there are serious corporate governance issues facing the industry in India, and how do you think one should tackle
Facing the funds, you mean?
in funds in India when they're investing?
In that they're investing in companies where there's governance issue at the fund level?
In the companies when they're investing in.
Srivatsa, my comments were at the private equity level. So at the company level,
Yeah, no, look, at the company level, there are serious governance issues. Depends how you define governance. I mean, my view of governance is that you run something that as an institution would, and you respect the voice of minority shareholders. I mean, it's a joke. There is no, on corporate governance, India is still way, way behind any developed market. If that's how you define corporate governance.
Why is it then that funds, many funds, knowing the issues with
No, so
certain
you have to
promoters?
be, I mean, look, we always knew this. It doesn't mean people are stealing money. When I say corporate, they're different. They're stealing money. You run the business in the interest of your family. And then there's you run the business in the interest of all shareholders.
Let me be more explicit. I'm also talking about funds which have invested in companies which are stealing money. And you know who I'm talking about. There are many, many examples today.
Yeah.
The Enforcement Directorate and CBI won't be serving them notices if they were not serious violations.
Yeah, so I think, look, I don't think a lot of that was done knowingly, if you ask me. I think, as someone pointed out earlier, we were in the middle of a bull market, and, there was a tendency to think that almost everything will make you money. So I don't think people knowingly put money in saying that this person's stealing money, and I'd like to encourage that by giving them more money. So I think those are genuine mistakes, is my view. I mean, there may be one-off situations here and there, but genuine mistakes. But I think the bigger issue is that whilst we may ignore that universe, there's still a large universe of companies in India where the business is essentially being run with the promoter's interest in mind, without the adequate respect for minority shareholders. That's my broader point. It's not the stealing issue.
Let me nuance the question a little finer and ask Sandeep. Sandeep, when we look at corporate governance issues, the related issues are in the first 5 years you spoke of investment, and the second 5 years where you harvest. Now, the management fees, 2% of whatever gets deployed, a very large sum of money. And there are enough investors in this country who, when they push out capital, are sitting happy on the 2% management fees. In other words, I'm trying to make a distinction between doing deals versus doing good deals. Many of them are very happy doing deals, pushing money out of the door, earning the 2% management fees, and sitting on that in the first 5 years, rather than actually waiting to do good deals. Would you agree with that? And if so, what do you think is the solution to this kind of a problem?
Yeah, I think I find myself in a fortunate place. At GA, we have evergreen capital. We don't do fundraisers. So as a result, we don't have that kind of fund structure where we need to deploy in the first 5 and harvest in the next 5. So I think that makes us better suited for this market. But I think it's institution. It depends on institution to institution. I think if there is a lot of pressure to deploy capital, what would happen in those cases is, if you find a good deal and it's intensely competed, you may want to relax some of your findings on governance because you just feel that it's okay because we can just ride in and get out before the lights go off, right? And that's the mentality that was there in 2007, 2008. And you always get caught in the room with the lights off. So I think that's what's happened in a few of the cases. Having said that, I think the 2% management fee versus carry, what we need to understand, and I think the industry is aware of, is it's a marathon. It's not a sprint. Private equity is a marathon. It's not a sprint. And just pushing out money in the first 5 years and not making any money later on, if all your assets are marked way below market, it's not a fund that's going to be sustainable in India. And the investor himself or herself is not going to be around for too long. So I think that realization is there. So maybe in the heydays, people were pushing out money not because they thought, let's just make the management fee on it, but because the markets were such that people just thought that everything is going to make you money. So there was a little bit of lazy private equity that KP mentioned, or I think Jadip mentioned that was going on. But I think that's gone away. I think we're going to see we're going to see some intelligent investments going forward.
Neeraj, you're one of those funds which has not deployed too much capital. You've been very cautious in deploying capital. Would you share Sandeep's view, or do you think it's actually good that you've not invested too much and you rather waited for the good deals than push out too much of capital and earn the management fees?
So I think we've got two funds. So we've got what we call the buyout fund, which is basically targeting larger deals of 75 million plus, and we've got a growth fund. So in total, we've actually deployed close to $1.5 billion over the last 6 years. So I wouldn't say we've
I was
been
looking at your side.
On our side, right?
Yeah.
So I think on the buyout side, I think we don't feel like there've been large deals which have happened, which we've missed out on, right? So I think part of it could be that there are certain large deals which have taken place where we felt the returns wouldn't accumulate. Ultimately, this game is about returning capital to your investors on the money you invest. It's not about management fees. You can maybe do that for one innings, but you won't get a chance to play the second time around, right? So I think
the point I was making was you make so much the first time around, even if you don't return capital individually, the incentives are misaligned.
But I think there are enough checks and balances in the system that people are aware of that. I mean, you go, they're very rigorous. I mean, for all of the, I mean, Sandeep, Akhil, right, for the big, in the big fund, there's a very rigorous process around this. You can't just sort of slide by an investment because you think, you can deploy some money and get the 2%. No one's actually thinking like that. You're actually trying to justify the investment on a standalone basis, and that actually what develops your track record. You look at KP and Ashish, right? It was because they did great investments. Must have thought, let me deploy the money, and that's fine, right? I mean, there's a bigger game.
I don't necessarily mean people on this panel. But
yeah, there's a bigger game here. I think there might be funds who are trying to get out there and get the management fees, but then I think that's a problem that individual fund has. I don't think it's a systemic problem for the industry. To your point on corporate governance, I just had a couple of points there. One is, corporate governance in emerging markets tends to get a spotlight, which is much more severe than what happens in developed markets. Obviously, India is not there from corporate governance. It needs to improve. But there are examples in the US as well, right? There's a company called Canopy Networks, which I don't know whether many of you have heard about. It was a company which all the marquee Silicon Valley venture funds chased. And then, after they did the deal, 3 months later, they felt the numbers weren't being met, and they called up KPMG and said, the company's not on track to meet the financials. And KPMG said, that's great, but we're not auditors of the company. So what the CEO had done is he had actually taken KPMG letterhead, put his financials on top, and sent it around, to all the investors, right?
Practices from India.
So, I know maybe it's learned here. So I think that's part. So it's a problem everywhere. It's a more severe problem here. I think secondly, you've got to do it in a win-win situation. If you go in thinking as an investor, the promoter doesn't want corporate governance, then you're just going to lose the battle. I think it has to be the situation, and there's a subset of guys you cannot work with. I totally agree with that point. But the majority of the people land in the middle, where they haven't thought about it, and if there's a trajectory by where it's a win-win situation, they get higher returns, they can get valued higher, other firms will pay up for that corporate governance. There's a situation where they actually align with your interests.
Let me move into a slightly related and different area and bring in Akhil on. Akhil, the whole issue of interface with government and tax. We are having a scenario where we've had the Vodafone case. We've had a situation where companies like Microsoft, Nokia, have for the first time ever in their history of their existence in India, have had a fairly serious run-in with the tax authorities on their interpretation of R&D and taxation of that in India. And the matter is so serious that it's well possible that we might see something drastic happening soon. Akhil, what's your view on the industry's interface with the government, especially with the tax administration?
One of the worst things we ever did to ourselves was to do this retrospective taxation in the car. And I can tell you how we responded to that. So I had to then propose a memo to my investor committee and my chairman. Look, I presented to you that there will be no capital gains tax because we have come from Mauritius, and we have the top 4 law firms of the country gave us an opinion that if you have a tax residence certificate, you have this, and you come from Mauritius, there's no capital gains. So I said, look, the worst interpretation I can say is that if this goes through, which, by the way, I don't think will go through because I don't think there's support neither in the government nor amongst, I just don't see a support. Somehow this has gone through the budget. But worst thing this can happen, that's the discipline we have, that we have to paint the scenarios. We can give the probability, but we have to say the scenario. And here's the response that I got. Very angry that, look, every time we asked you, would the government take this mine away? Would the government take this contractor away? Would they change this? You told us, we're not a banana republic. Now tell us, what do banana republics do? Right? If I come with a set of laws and I cannot rely on that and you can retrospectively change on me, why should I ever invest in India? Right? And really that was the sentiment. So when 2004 we came in, the sentiment was, I don't know what deals are there, I don't know what size deals are there, but we have to be in India, right? To the sentiment saying, okay, if India is going to behave like this, put 20% capital gains tax, put another 5% rupee depreciation because money is not going to flow into India, Indian currency is going to depreciate, and how many deals can pass muster with that kind of thing? I lost 3 deals, $275 million in that 1 week. So I think it's not a question of being right or wrong. I met a few secretaries who were telling me how this is right. I said, look, we can debate forever what's right and what's wrong. The question is what impact you're going to have on your foreign investors, and is that the impact that you desire? Right or wrong, they have a mindset. I say, I'm an Indian, I've come to you as a concerned Indian that with our current account deficit running where it is running, we need to create positive impact, positive sentiment, so that investors want to come and feel secure here. So,
Vijay, do your principals also ask you why we should be investing in money into India?
No,
On the issue of, focusing on the issue of tax and interface on regulatory.
Yeah, absolutely. And see, there are a couple of implications here. One is, Banana Republic is like, it's a very nice
it's an
way
angry
of
response.
Yeah, sure, it's an angry response. But even if you soften it, right, it just means a lot of uncertainty, right? So it has two implications. One is less money will find its way into India, and two is India will always be seen as a high return. You need high returns to justify being in this market. We don't want that. It's not good for anybody. It's not good, and especially because 80% of the capital, and I'm just using this very loosely, right, is needed for basic stuff like infrastructure, roads, power, your mines, etc. These are the capital-intensive parts of the business, right? You don't want to have a reputation in the market which says that this is a high-risk market, because typically, high risk always equates to higher returns, at least in terms of paper, when you're looking at ascribing. So if I go with, say, hypothetically, a 15% deal, people will laugh me out. Even if I chair the investment committee, the other members will still laugh me out, right? So, that's exactly, I think, where Akhil is coming from, is we have to reduce the sense of uncertainty, and the biggest, contributor to the uncertainty is the government, right? There are so many other things in business which are uncertain. We were talking about corporate governance, we were talking about, promoters, we were talking about business models potentially changing, right? Hardcore execution issues, right? Rains happening, floods happening. There's enough uncertainty in the world without the government actually contributing some more to it. And they contribute maybe 60% of the headache and the uncertainty.
Let me ask Ashish a related question to you. The whole Mauritius route, there's often discussion this might get shut down at some point of time. And I tend to draw the analogy with the Lok Sabha petition that every politician files when he stands for election, saying that I only spent X rupees on my campaign, which is an utter lie to start with. And many of our private equity funds start by saying we are in Mauritius, all our meetings are held in Mauritius, when we all know that doesn't happen. What will happen if the Mauritius route actually shuts down? And do you think that to be a serious possibility?
So first, let me just start with a small story, taking off from what Vijay and Akhil were talking about. When we were raising capital in early 1999, one of my mentors introduced me to David Bonderman. So I wrote a letter to David Bonderman soliciting, requesting for a meeting. And those days, we sent faxes. So I sent a fax to his office. Lo and behold, the same day, I got a reply. On my letter was signed, "Life's too short to invest in India!" ! Signed David Bonderman.
I hope you still have that framed somewhere.
Yeah, eventually got the meeting and got them interested and all. But they had basically written off India. At that point, Newbridge was investing in Asia. India had been completely written off. And if you look at FIIs, there was a lot of excitement in the Indian market around the 1990, 91, 92 time period, 93, and then up to almost 2003, 4. This was a dead market from foreign investors' perspective. I think there's a real danger that if we were to shut down the Mauritius route, that if you look at the proportion of FDI that comes from private equity, that it would destroy the private equity industry. Secondly, with everything that you're talking about with Shell and Vodafone and Nokia and Microsoft. I think there's also, again, a real danger that if we go, over the top, I mean, if you look at the Shell case where it's an issuance of shares, and if you deem that to be a taxable event because of valuation, par value versus, I mean, I don't understand the logic where when you issue shares, how that could be deemed to be a taxable event. So I think there's a real danger that we're going to lose lots of foreign capital, not just private equity capital, but multinationals. I mean, what does it take for Walmart, which has 400+ billion of revenue, to write off India? It doesn't take a lot to write India off. Just say, next 10 years, I don't need to be there. There's a real grave danger that we actually are headed in that direction. With the undue, I mean, GAR was the worst, but there are several other steps, like you said, that have been taken that have really made people extremely nervous.
Can I just add? Sure. To what Ashish is saying, I think there's a real danger. I'll give you an example. You all know the Enron double project, right? What happened to that? Now, if you look at today, one of the sectors that needs foreign capital is power sector. If you look at electric utilities in the United States, their cash, they're loaded with cash, they're sitting with 5 to 6% yield, right? The minimum that even CERC gives you is 17, 18%. Take 3, 4% repeat appreciation, you get 14% yield. Yet, nobody's there. Why? Because that one Enron happened 20 years back. So I want us to remember that I think these companies have long memories, and exactly right that they can say, okay, fine, so if you don't go to India, so be what? At least I don't want to be criticized of knowingly that Enron happened, you still went to India, and then, I ended up not making the right kind of investment. You are much more vulnerable.
Yeah.
So I think there's a lot at stake in terms of a misstep towards foreign direct investment. And the second thing I want to mention is, even today, if you look at it, there's a bias in favor of FIIs, right? We all know how volatile the FI money is. So still, we haven't really proactively done whatever we could do to encourage FDIs.
Yeah, if I could just come in here, I think the global sentiment on India is definitely muted right now. And I was at the World Economic Forum at Davos, where you get a good feel of what's happening with different countries, and clearly India was significantly muted.
And you made that famous statement, we need a credible India, not an incredible India.
Yes.
Exactly. And, that's a very good statement, actually.
The Incredible India campaign. We just need a credible story because our image is totally oversold right now, and we have not been able to deliver that. And so people are saying, to Neeraj's point, okay, we have heard the billion people, we have heard domestic consumption, 50% of the population at 25, all those facts have been just, put out there, but where are you delivering? And when you meet some of the people that really matter in our government, and when you talk to them, they say, where else is money going to go? It is going to come to India.
That's right.
So I think somewhere that complacency that the money will eventually come to India has set us back in the last couple of years. And unless we start focusing and delivering, money will go to other countries. I mean, this time around, Africa was the big thing that everybody was talking about.
Indonesia?
Indonesia is another big thing that people are talking about. When we speak with the big Indian conglomerates and the industrialists, their incremental dollar is not being invested in India. That's being invested in Indonesia and Africa and some of these other emerging economies. So when your own Indian money is not coming back into India, so expecting foreign money to come is a much...
You're one of those who feels that the I in BRICS would soon not be India but Indonesia?
It's possible. I haven't studied Indonesia to that extent, but the I in BRICS is definitely moving away from India. It's totally in our control. We can still deliver, but we better get our act together. And we probably have another couple of years to do that. In the absence of that, if we continue with the same status quo, I think the confidence will definitely diminish.
Let me move to a related point on Vijay and then KP, on SEBI. SEBI has so far been seen as an industry-friendly regulator. Though we had some recent cases where the case of Clearwater Capital and Kamath Hotels, and a couple of other cases which are not so much in the news on minority shareholder rights. Any thoughts on how SEBI is going or what they should be doing versus what they are doing?
Yeah, my own view is very positive. I think this trend towards giving minority investors or minority shareholders a much stronger vote is a very strong trend. I think the concept of, well, as an investor I may not fully like it, the concept of IPO price protection for retail investors is also potentially a good trend. So overall, can't fault SEBI too much. I think Mr. Sinha is trying to get a few things done. Hopefully it's good.
Vijay, you wanted to say something?
Yep. I just wanted to add to the previous discussion, right, in terms of this uncertainty. There is only this much that demographics can take us out, right? Now, there is a timing issue here. At some point in time, even China is now becoming middle-aged.
Demographics sounds like the Manmohan Desai lost and found story. We are done with that.
No. All I'm saying is that, when people say that where will the money go, etc.,
right.
If it comes in 10 years late, it is way too late, right? We have to create wealth now. Otherwise, there's so much, there's so many people, youngsters, etc. If they don't have opportunities, jobs, etc., we're going to have a look at big social issues, potential, right? So it's not a question of, if the money comes in 20 years later, it's of no use, right? By that time, you've already become middle-aged in terms of the entire demographic. So, which is why we need to get our act together now. We don't have too much time. We have to get our act together now to get the capital flowing back. And there is this halo effect. It's not just FDI, it's not just private equity, it doesn't matter. But one or two big cases like this, you're going to have a big halo effect. A lot of other people are going to get scared away. So that's the whole point is, we need to get our act together now.
I just want to quickly add to that. I briefly lived in Brazil in 1996, and Brazil was running a large current account deficit at the time. They were selling off their PSUs to get money in, like we are busy selling off NTPC and everything else, desperate to get money in. They ran a fiscal deficit, all the issues. And one day, the shoe just dropped. And I think there's a real, we are not factoring, there's real event risk here. That if foreign money just stops coming or just says, I'm writing off India, rupee is going to go to 100, in that scenario. Really.
And do you think that's a real scenario? You think foreign money can actually stop coming to India?
It just, remember, everything is on the margin, right? We're not talking about it going to zero, but if it shrinks, we've got a current account deficit of almost 4.5% right now.
Highest ever in our history.
Yeah, and it's very risky. I don't know if you read Y.V. Reddy's new book. He's a man whom I respect a lot. And he said, our folks have become very complacent. They've even set the current account deficit target. Montague talks about 2.5% to 3%, whereas it should be 0. And he's absolutely right. If you study economies around the world, they've always hit a crisis because of this reason. And so there's a genuine risk here. And that's why we need to take this even more seriously. We're playing with fire here, is my sense.
Let me go back to the issue on SEBI and minority protection. Akhil, I know you had some time back significantly different views with the government on this, on minority protection. How do you see that versus SEBI's views recently on the subject?
See, I think that private equity investors in a minority position are in the best position to really safeguard the interest of minority shareholders who are even outside the company. Because the kind of diligence with which we can monitor the company, average stockholder cannot. So I think to that extent, rather than putting burden on us by holding us as control shareholders, I think SEBI should see this as something very positive, that you have private equity in a minority situation as a representative of the rest of the stockholders doing the kind of diligence and supervision that we can do. I think it's a very positive thing, but we have to see in the right perspective. Right, we're not controlling the company. It is not in our interest to control the company in a way the company should not be controlled. All we are doing is making sure, and especially everybody's talked about corporate governance, and I tell you, all of us, if you talk to us one-on-one, and since we're supposed to be honest, I can tell you the biggest risk to private equity is the promoter risk, right? Because the numbers you get, I've learned the hard way that there's a very, very limits to outside intelligence. The numbers look very different when you go in the first quarter versus the numbers that you saw outside in. And there's just no way that you can get around that. And obviously, since I didn't ask that question, very important question you asked on corporate governance. Let me tell you, if Indian companies had corporate governance, you get 3-4 times the money flowing into India. I have, and I'll give you two instances of that. Blackstone takes corporate governance very, very seriously. In one case, I had a $250 million deal. And we're doing the diligence. Everything was working out fine. So finally, we get the accounting report, and we learned some channel stuffing, right? So we confronted the promoter, and he admitted to that. And I said, why don't you just, in the next, it's a public company, in the next board meeting, just say we have a new investor coming in, and by the way, we have more conservative accounting policies, so just correct that number, and anyway, we are providing a floor to the stock, so you don't have your 10% downside, not much. And he wouldn't do it, and $250 million deal, I walked out. And it was not that much, it was like 6-7% difference, but to me, it was a matter of principle. We didn't do it. I'll give you another very good example. This is a positive thing. We had two actually groups coming to us, say, we want to invest, and we were very open. Look, you're whatever we hear, and news, reputation, this, that's exactly the reason we are coming. Okay, now we want to be known as Doodh Ke Dhuli company. And we'll show you the real books, and we'll show you the books we have presented. So there is a growing awareness that, yes, the private equity money will not come to the promoters, to the companies that actually are not following the standards of corporate governance. And I will say, more than money that we have given as private equity to the promoters, I think every one of us have brought higher standards of corporate governance, and that's a much bigger contribution by private equity to India than just the money.
I think I should wear my IAS hat here and say that while the license Raj has by and large gone away, except perhaps in ministries like environment, license Raj continues to exist in the mindset of many Indian promoters. The license Raj has left the government, but it continues to exist in the mindset of many promoters, which has been testified to by Akhil as well and many others who have seen many different sets of accounts. One to show to the world, one to show to the investment authorities, one to show to your private equity investment committee. Okay, we are coming towards the end of the panel. I want to leave enough time for question answers. We are at a time when we are facing the highest ever fiscal deficit in this country's history, touching 10%. Highest ever current account deficit. Economic reforms is almost dead. I would like to ask my panel, I want to quote also from research from NetScribes, which does a lot of research on private equity around the world, which says the sectors to look forward to are healthcare, IT, ITES in India. I'd like to have my panel speak on the macro and on industries that they are looking ahead to as part of their closing thoughts. Can we start with you, Neeraj?
The macro is not great. I think we've talked about it, but I think this is precisely the time private equity will make great investing opportunities, right? Because if you took my snapshot of the Indian economy right now, it's bruised but not broken, right? When we talk about demographic dividend, when we talk about sort of the multiplier growth we'll get from infrastructure, assuming that happens in a certain time frame, right? We as private equity investors will benefit. I don't think this will be, as to Ashish's point earlier, this is not the 02 to 07 time frame where you just get into the market and there's a rising tide which carries all funds forward. I think this will be a market where being selective about investing opportunities, finding companies which are understretched but are in good businesses will lead to attractive returns. So I think the fact that the macro is not strong is actually great for investing, right? As long as you believe that there's a long-term potential to this market, which, I mean, most people would argue yes. And frankly, I think we've discounted growth a lot on this panel, right? I mean, having invested a bit in the US as well, I would any day take investing in a growth market because it allows you a lot of other areas and still allows you for value creation versus trying to invest in a 2% GDP growth market, right? I mean, they're just fundamentally different investing philosophies. From a sector perspective, I think is what, I mean, at least I don't think I'll say anything different than what my panelists will say. We like the domestic consumption story, so around that come healthcare, financial services, the consumer sector, and then our other thesis is really backing emerging global champions from India, so people who can lead domestic as well as global consolidation in sectors such as IT and pharma. So those are the sort of the two broader themes we're investing behind, but we put a lot of credence to working with great promoters, right? And so we're somewhat less focused on specific themes. If we find the right business with a great promoter, we believe we'll create value with them.
Ashish?
Yeah, I don't have a great view on sectors, but my view is that the macro, whilst is shaky, so there's some event risk, but if I look at growth, from a 10-year standpoint, I think India is poised to grow at 6.5%, 7%. I mean, if we accelerate reforms, like Akhil said, we could grow faster. I think India will hit a brick wall in 2025, is my sense. We're going to fall into classic middle-income trap, and I'm almost sure of it unless we start addressing those problems today. So there's a real issue about what happens beyond 10 years. I think as far as the fiscal deficit is concerned, I don't think India has ever been good at controlling the fiscal deficit. The desire to spend money is always great. The ability to collect money, because tax compliance is so low, is a real issue. So I think the one big thing we need to push on is individual tax compliance in the country.
Not through higher taxation?
Possibly through higher taxation even. 30% is low. I'm not denying that. I'm not suggesting we should take it up to 50. But I think the bigger focus, as opposed to raising the 30% today, the bigger priority should be to go out and actually get people to comply with the law, with the tax rules as they stand. I mean, if you look at personal tax anywhere in the world, it's the single largest. In the US, they collect 900 billion of personal tax and something like 200 billion of corporate tax. India is the only country in the world where out of our 5,70,000 crore direct tax target for this year, individual is less than 2 lakh crore and the rest comes from corporates. So there's a real issue there. And I don't think we'll ever have forget about fiscal surplus, we'll ever narrow the fiscal deficit to a really manageable level unless we can address that issue. Because the desire to spend will always be there, given that we're a poor country, given that, you know, the vote bank is out there and people will want to spend. Current account, I think we really, I mean, you know, it bothers me that when the rupee slips from 40 to 55 and we still are not competitive, the fact that if you look at our trade deficit, there's a $10 to $12 billion gap. This is with
I think I don't think our story is completely derailed. No, is it bruised, not broken? Is it shaken, not stirred? You know, up to people to decide. But I think we need to act, and we need to act now. I think that's been very clear. In terms of investment opportunities and where are investments, it has to be something that touches the consumer. So it could be healthcare services, retail services, consumption, financial services, anything that interacts directly with the consumer. I think there's if you look at short term in the next year or two, there's a lot of direct transfers that are happening into banks of you know, the rural and semi-rural. So it's Bharat that's going to drive India, not India driving Bharat. And so you need to think about what kind of opportunities would that entail in terms of going into tier 2, tier 3 cities, either setting up healthcare services there, or hospitals or clinics, or providing them with the consumer goods that they aspire for. So I think those are kinds of opportunities that we are looking for. I think it has to be a thematic investment where you have to identify a particular theme that you like and you enjoy, and you think that within that theme there are enough tailwinds that could just carry that particular industry. And then within that industry, you need to identify the number 1, number 2 player that you think have the best management and the governance that you can back eventually to try and make the alpha that you want in the industry.
Akhil, what are your thoughts?
So I think just summarize what my colleagues have said. Fiscal prudence and reforms, that's the need of the hour. And if we do that, then I think we can restore the economy back to the growth. And then all sectors do well, and we are a sector agnostic firm. So I think sector, we think we'll see opportunity everywhere. You know, positive and negative, I think before Mr. Chidambaram came as finance minister, I was actually very nervous about what's going to happen to our economy and our deficits. And I think he's shown a huge amount of courage. Obviously, he knew what to do, how to fix the economy, come out with a lot of creative thoughts, courageous decisions. So that is the encouraging part. And hopefully, I think he'll reflect that in the budget. I'm very confident he will.
You're not worried it's going to be a populist budget, the last budget before the
so
next general election?
I'm just taking Mr. Chidambaram for his word, and I think he understands Dr. Manmohan Singh, and he understands the implications of doing the populist thing. I think we are on the precipice. If we were not on the precipice, I think probably they would err on the side of the populist. But we are at a point where I think things can spin out of control, and I think they're very aware of it. Dr. Kelkar, who's our advisor, he had a lot of discussion with both of them, and you know, remember his panel gave the advices to how to bring fiscal prudence. So I think based on the conversation, both of them have shown a huge amount of courage in taking some of the tough decisions. My concern, and to that extent, I'm cautious, and I think I'm going to remain super cautious. And it's not that Usually I was one of the person who evangelized in the firm that, look, India takes 3 steps. India will always be, right from the beginning I've told, India will not be a linear story. It'll be a few steps forward and a few steps back. And hopefully, as we go forward, the number of steps forward will be more than the number of steps back. Now this time, and that's when India takes the step back, that's the time to invest and aggressively invest. And if you look at the last few times India has actually taken those steps back, if you invested, you really did very, very well. This time I'm not so sure I will give that advice, because I think there's another big uncertainty that's looming large, which is the elections. And all scenarios, at least, and you can be very wrong about it. You can be much more wrong about politics than you can be about your investing companies, right? So I won't hazard any guess. But everything that I'm hearing is that probably Congress and BJP both will get lesser than they have before. So I think governance will be a huge issue. And I think, to me, that's the biggest risk to our investing in the future. So you have to be cautious.
Vijay, are you going to be putting more money into India, and which sectors?
Yep. Absolutely. India is going to be a focus for us. We do all hard assets. So it is going to be infrastructure, logistics, transportation, healthcare, education. It's all there. And I'm not so worried about the current account deficit as much. It's not going to get solved in the next couple of years, right? It's going to take a few years. So long as...
It get worse than where it is.
No, even if it gets a little bit worse, so long as the government is able to get capital flows in, right, they can balance the current account deficit issue short term. Longer term, of course, they need to get their act together, and I'm saying longer term, even 5, 6, 7 years. But so long as they're able to get capital flows in, that part of the issue, can be largely mitigated. But to do that, they have to reduce this uncertainty. This, idiotic concept of, this tax thing and, all these kind of laws which keep getting changed every now and then, all that kind of, noise should be stopped. People should understand, as, Ashish was saying, 2025, what will happen? I mean, now is when you have to plan for the 2025. Now is when you need to have, the kind of power plants which, he's put money into, right? You need to have the roads, the logistics, right? I mean, all of that will bring capital flows in. It will consume a lot of capital. That's where we're going to be focused on. But that's where the government has to, take full responsibility to get it in. After that, the current account deficit and stuff, it'll have to get worked on, but it'll take a few years. They can't just stop, whatever development work they're doing right now.
KP, final word.
Yeah, from our side, definitely quite positive. I think the focus will remain on investing behind smaller companies that are probably not early stage venture, but not classic private equity, but sort of later stage growth, later stage venture sectors like consumer, healthcare. My own view is the next couple of years, especially that part of the market, you'll see some landmark companies getting built. If I look back at the last 4 or 5 years, a number of examples. I think in healthcare, companies like Vasan or Dr. Lal's, in technology, Just Dial, Mu Sigma, in the internet space, Flipkart. So I think for the first time, I think the later stage venture, early stage private equity, you're going to see some phenomenal success stories, and I think that it's good for that part of the market. It's also great for the buyout late stage private market, because hundreds of such companies that have an existing investor, better governance, clean stories, is good for the Indian private equity market overall. That aside, not thinking as an investor, but as an Indian, I spent a lot of my time traveling across smaller cities in the south, Valapad, Trichy, Madurai, and to Ashish's point, longer term, I seriously worry about the future of the country. And the reason is, I just see a sort of a breakdown in the healthcare system, the education system. These are sectors I spend a lot of time looking at as an investor. A lot of worry about, will we reach crisis levels within the next 5 years? Because people are not in school, they can't afford healthcare. And those are areas where there's huge failure of government.
Okay, we started 10 minutes late, so we have about 15 to 20 minutes for question answers. I would request whoever's asking a question to identify himself first and wait for the mic to reach them, and then ask the question to a specific panel member, or if you wish me to direct it to someone, I'm happy to do that. Yes, please. The floor is open for questions.
answered all the questions.
Up here. And tougher the question, more fun it is. Don't forget you're on national television.
This question is to Akhil, and this is about the large private equity global funds, starting, NBFC arms in India and deploying, debt to large Indian corporates. How do you see that phenomenon? And also in the real estate space, we seem to have completely moved away from equity to pretty much, debt-only kind of scenario. So, is equity magic going away? Is that why debt is so hot among the big global guys?
Tarun Natarajan, the organizer of the conference.
Okay. Tarun, I think every fund or company has a different risk-reward ratio where they play in. When you look at Blackstone, we have pure private equity. We have GSO, which is the piece that you're talking about. We're not in India, but we do that. So they're not mutually exclusive. It's a question of what do you want to focus on based on what you think you're good at. So as far as Blackstone is concerned, we have made a conscious decision that we don't want to go the NBFC lending route. Now, we like NBFC space. We looked at several opportunities. We didn't invest in them. In retrospect, we made the right decision because valuation was too high. I think NBFC space has become pretty attractive in today's valuation. So as we speak, we're looking at a couple of NBFC. So we'll invest in NBFC company, but not as lenders because we want to focus on private equity. I don't understand lending business. I don't want to create new strength for that. There's enough for us to opportunities in the private equity to focus on. But I think people who are focusing on that, they're doing the right thing. As far as real estate is concerned, we have actually, I personally feel that real estate is a much bigger opportunity for India than private equity is. You just have to look around. The whole country has to be rebuilt. We were very cautious for the first 3-4 years. But last 2 years, we've become pretty aggressive because now the valuations come down to the reasonable levels. There are properties that we bought, they were below the replacement cost. And you can't go wrong when you do that. So that's my perspective.
For you. My name is Sesh from Basis Fund Services. I have a question. The government has always been talking about financial inclusion, and microfinance and microcredit was seen as one method of doing that. Obviously, there were some disconnects along the way. Do we see it coming back? Do we see it coming back in a different form or substance?
Question is to?
I leave it to you to direct.
Ashish, given your now interest outside private equity, why wouldn't you answer this?
Yeah, I don't have an interest in microfinance, but I think that I don't see the microfinance sector coming back. I do see banks over time being much more, being pushed to and taking a larger role in financial inclusion. But I think this model of saying we're going to lend poor people lots of money very quickly and we've improved their lot, I think is a wrong notion, frankly. We need to get out there and inculcate saving habits. We need to make loans available when required. But I just don't think the model we had with microfinance was just completely flawed in my mind. And so it was, I know there was the regulation in Andhra Pradesh, but I just think that it was bound to end up the way it did, given the pace it was growing at. So I think the banks are better placed to do it eventually. I know in India the banks are bureaucratic and they move slowly. We need to figure out how we can, get more branch. I mean, I still think India is underbanked. Rural India of making it work, but we need to figure that out.
I have a contrarian view, Ashish. I think you're right that probably in the longer term, the banks will have to deliver these services. But if you look at the branch economics and the cost of delivery for these branches, they're not able to do it, which is why for the central bank, financial inclusion, though, has been a theme. It is something they haven't been able to deliver. And given the regulatory clarity around microfinance now, where you can only lend at 10% above your cost of capital, what's happened is that the industry has significantly shrunk because all the players that were doing this business at the seat of their pants and charging you serious rates have now disappeared. There are few players, and I think KP should speak, that there are few players that are remaining that are trying to do this the right way, earning ROEs of 14, 15%, which is pretty sound for this kind of a business. And given the constraints that the regulators have put, it's very difficult now to go around and grow at 80, 100% by doing wrong practices. So I think given the environment and the constraints that have been put around the industry, if the economics of the industry is viable, I think there will be a few players that will scale up and actually do the financial inclusion that we're talking about. If, given the constraints, the economics are not viable, I think the industry will die a slow death, at which point the banks will be forced to provide the service.
Yeah, my own view is, I wouldn't call the industry microfinance. We were very early investors. We were the seed investor in SKS, and we're still investors there. So we've been through a pretty interesting journey there. We're also an early investor in Ujjivan and Equitas. We're also an early investor in Manappuram in the gold lending side. So I think if you think of the industry as trying to help someone who needs a loan the same day, it's typically a very small ticket loan. Very often it's a woman who's anticipating a check coming 2-3 months later. That industry has tremendous potential in India because it is not being served today. And I'm not too sure banks are set up to serve that customer base today. And very often that customer doesn't feel confident going into a bank branch. So I'm pretty hopeful. I see the better companies in those markets doing quite well for the next many years. But I think the challenge of microfinance and some of the other markets is the industry grew too fast, and they have to adjust to the pains of the past.
Yes, please. Yeah. At the back. Questions here. Get a mic across to him.
Hello.
Yeah. Okay, sure. Why don't you go ahead and next one here.
My name is Alok Gupta from Capital Associates, and I have 2 quick questions. One is for Akhil. There has been some development of large foreign private equity players coming into India and doing some joint ventures, whether it is for with say large banks, whether it's for distressed funds or financial services or real estate. Do you see that momentum picking up? And another question is for Sandeep. General Atlantic, you mentioned, has got long-term capital. So other than the bridging the gap between the cycle of investment and exits, what are the other benefits that you see, and why is that model not more popular if it is really strong?
Okay. I'm not aware of many joint ventures that you're talking about, and I think based on most of the private equity players I know, I think they will rather, control whatever they do in India. Working with Indian partners is quite difficult, as I think is pretty much, experience of most, especially people in the financial services have proved that out, that I think it will be very, and it's very restrictive in terms of what you can do in the future when you want to get things done on your own. So my perspective is any major player who wants to come, they will hire people like us sitting here who understands India and also, have understanding of the Western culture they want to come in. And that's a safer strategy. At least many times I have been sorted. People have come to me and advice, and I said, look, you're much better off hiring somebody who understands, who can bridge the two cultures and the two economies, understanding the two economies, and you're much better off. I think most of our heading that way, and maybe my colleagues can add a subtract.
Never thought of hiring IAS officers who understand India much better than you do?
No, because I think
can't afford them anymore. Yeah?
No, I think I have a perspective on that. I think there's so much IAS office can do by governing rightly in the country that we can solve all the problems.
No, we thought we now with people like Nandan Nilekani and others coming into government, we are leaving the space for people like you to come into government and solve those problems, whereas we move this side. Yes, Sandeep.
Yeah, on the evergreen fund, I think there are 2 big advantages. One is just the staying power of not having to exit a company when you don't think the company is at its optimum, and hence just being able to stick on for 7 years, 9 years, 10 years, whatever need be, to make your returns. The other aspect of it is on the fundraising side. You're never exposed to a macro climate like what it is today. Today, the funds, or the mega funds that are out there, are finding it difficult to raise the mega funds that they had initially raised 5 years ago. And you then have to look at your employee base, you have to look at what kind of salaries you're doing, and you have to right-size it. And so every 5 years, you're basically betting your firm based on the next fundraise that you're going to do. In the evergreen capital that we have, we don't have to do that. because we have a steady flow of the same capital that we churn. And as a result, there's much more stability and much more visibility in terms of what you want to do and how you build an organization. Why wouldn't other funds want to do an evergreen capital? I think if you ask anybody at the table here, everybody would love to have evergreen capital, but it's just the nature of the industry out there in terms of institutional investors who would not agree to this kind of a capital base for any new fund that wants to raise money right now.
Yeah, I have to further my comment on what Srivatsa said. Imagine if the brilliant people that we have, one of the brightest people, they go to IS, and the powers they have. Imagine if they can take one KRA to bring India from 1/30th of ease of doing business, right, to 50th in ease of doing business. What magic can do for your country?
Hey,
so Srivatsa, that's the KRA for you.
I will sprout the same Vedanta if I was reporting to Stephen Schwarzman and not to Pappu Yadav. All the Vedanta even I will sprout and talk about moving from 50 to 1. You report to a Stephen Schwarzman, not to a Pappu Yadav or Mamata Banerjee. Leave it at that. Yes, please.
This is Ajay Parmar from MK Global. First of all, I must thank you for your star-studded appearance. Basically, again, I would like to speak more on the issue of corporate governance. In fact, most of our part of discussion also was on corporate governance only. I believe it's one of the most important factors for determining the valuation for any company. And for investors, that is what we are looking at. Now, I believe that people are even willing to compromise growth versus the corporate governance. Now, my specific questions are for any one of you or all of you. Basically, have you seen in the last 3 to 5 years any change in the management in terms of corporate governance? Second, if you look at corporate governance in India versus the other emerging countries like Brazil or China or other emerging countries, how we are faring? And third, since you are one of the largest investors, you also have the opportunity to represent the board. In difficult situation, how you react, when there are corporate governance issues? And what are your recommendations to the regulators and other guys?
Vijay, why don't you take that?
Sure. By the way, this is an India-only panel, so, we say corporate governance problem in India. But it's a problem anywhere. I mean, I face the same issues, if not worse, in Indonesia, right? So Indonesia should be, probably the second eye in BRIC, but it's a tough market, with respect to corporate governance. And there it is, probably because I'm not Indonesian, so, I find it a lot tougher, right? China is extremely tough, right, with respect to corporate governance. So we have to be even more selective, right, where China is concerned. But having said that, there are other nuances to that market which makes investing there a lot more fun, right? So in China, for example, the regulators will bend over backwards and they will do whatever it takes to get your deal done, and it's very sensible. If there is a road, it goes from point A to point B. It's a straight line, shortest distance between 2 points, right? In India, it can go anywhere. We had to build, 41 temples? Right. We had to build 41 temples, in a small 40-kilometer stretch, right? I mean, small temples, any stone is a temple there, right? So, I mean, that's the biggest issue. Corporate governance is an issue across most markets. And by the way, you have corporate governance issues even in the US, right? You have corporate governance issues everywhere, right? The biggest failures, right? The biggest Ponzi schemes are from the US, right? So let's not get too carried away by saying that, it is only something special to India. But having said that, India today needs money, right? It needs huge amounts of capital to flow in, and that's why we're saying, let's focus on corporate governance, and it's part of our job. I mean, that's why, one gets gray or whatever it is, because you have to focus on that, right? So, I mean, I'm not going to get too carried away with, it being...
I would only partially agree on the corporate governance in the US. Yes, the biggest Ponzi schemes happen in the US, right? But 95% of the companies there will have, the right books and will have much, much better corporate governance, something that you can bet on. I can just tell you, when we are doing the diligence on our US companies, our level of corporate diligence is very different than what we do in the Indian companies. So I hate to disagree.
We are the mirror image. We have 95% of the companies.
Yes, thanks for
a different kind of.
Yeah, exactly. And I would agree with that.
No, what I'm saying is that it's not something which is very special only to India, right? I mean, you have corporate governance issues everywhere.
And very good point you made on China. So let me completely endorse you. I think the way we are behind is because our government doesn't help as much as they help in China. I went to a GE Access Summit in 2007, where General Electric had assembled it together. They got really speakers, inside speakers. It was a closed session. And one of the very informed person said, in China, the real negotiation will start after you've signed the contract. So, that tells you about the sanctity of the contract in China. It just doesn't exist. I think to that extent, we are much, much better off here. At least we have courts, and most of the time it takes, you're frustrated, but if you have a valid point, you're likely to win. That's not the case in China. You're not sure about that. But the government really helps much more in China than in India.
Okay, next question, please. Lady here.
I am Gitanjali. My interests are in the education and healthcare space. Just acquired a majority stake in a hospital. My question is we have discussed corporate governance issues in India and also logistics problems. The one question which I am grappling with, which I'm sure as a venture capitalist, private equity firm, you too would, is the inefficiencies in the banking sector, which makes the cost of funds at 14-15%, whereas the same, as Vijay would say, is 1.5 or 1 or 2% in other countries. So what is it that drives these inefficiencies? Because it is also a personal challenge that's being faced.
Who would you ask the question to?
It's open to whoever would like to take it.
Yeah, no, look, it's a fair concern. I don't have any easy answer to that. The cost of debt, unfortunately, I guess healthcare doesn't have any special sector status by the government, so it's not conducive for concessionary financing. One thing you can think about is, maybe getting on board an investor who takes part of the equity and then helps you build the business and not just rely on debt alone.
See, I think I can add to that. I think cost of funds has to do with the efficiency of financial intermediation. And I think someone mentioned we are very hugely underbanked. As we put more and more branches together, you get more and more deposits. Once you get more deposits, then you pay less on deposits. And I think you can bring the cost of down. And the second thing has to do with the policy, which relates to inflation and how much real interest rate you want in the economy. Most of the time, people want 0.5% to 1% real interest rates. So your inflation is high, then your interest is higher. So I think a lot of these things are interlinked, and clearly we can get to the lower cost of funds as our economy is evolving, as we get more and more branches, which the Reserve Bank is actually very pushing banks very, very hard.
Ashish, you wanted to add to that?
Yeah, so I think there are two factors. One is intermediation cost. So if you look at NIMs in India, which are 3.5%, something like that, in most countries, I'm talking about developed countries in the world, they would be about 100 basis points lower. So clearly we're inefficient, and we can lower intermediation cost. But the biggest culprit is not intermediation cost. The biggest culprit is the fact that banks' cost of capital itself is high. And for that, you have to blame the government of India. It's high because inflation is high because of supply-side constraints. And it's high because the government crowds out. The government sucks up so much money because they run a high fiscal deficit and artificially keeps rates high in the economy. So, I mean, that's the major reason why cost of capital is so high in India relative to China. China does the inverse, which is that because the government effectively taxes you when you put your money in the banks, they artificially regulate rates that they're very, very low. And then the intermediation costs in China a tad bit lower than India as well. But I think the major reason is not the intermediation cost. It's really the cost of deposit.
Let me move to, I think Dr. Ashraf had a question. We have Dr. Mohammad Ashraf, chairman of Kraft Hospital, somebody who is a leader in his space in IVF around the world. He's been chased by many private equity funds and he's held off so far. Dr. Ashraf, you wanted to ask a question.
Thank you, Srivatsa. See, first of all, I will congratulate the moderator as well as the panelists for having a good discussion in this. See, my question is a little bit different because I'm a healthcare professional. Like me, there should be many upcoming entrepreneurs in India in either healthcare or IT segment or engineering, like that. But what we have a certain focus. We have this stuff on us, but we don't have the wisdom in marketing or having multiple centers and acquiring and doing the things now. Because, see, right from, apart from funding, these, I don't know why these this marketing venture capitalists are not coming to help us in starting from the surveying, identifying the good focus or good situation where we can start a new venture, and then recruiting the HR, all stuffs, until we come to a high standard hospital or an IT company. If that is there, definitely there should be a good market for you as well.
Sandeep, as someone who has invested in Apollo and exited from it,
sure.
How would you address the concerns of someone like Dr. Ashraf, who says you'll only go to him after he becomes an Apollo, not till he has become an Apollo?
Yeah. I think it depends on the fund and the fund size and what kind of minimum equity check a particular fund wants to deploy. So there are lots of people who would want to take a company which is an early stage growth company and then not only give the capital, and I keep saying this, capital is a commodity in the Indian market. I mean, if it's just capital you're looking for, there are tons of people that you can raise it from. If it's true value add that you're looking for, then you need to really understand who you're going to raise that money from and what they can bring to the table. And Neeraj can attest to it. Neeraj and I were working together when we did Apollo. When we looked at Apollo, there was a lot that we could bring to the table because we had done a lot of hospital investments where we knew how to look across the value chain and improve your operational efficiency or figure out which are the new areas you can go and open your clinics, what is the patient demand there, what do consumers want, and then bringing that to the table saying, here's what we should do. So within the span of a year of our investment, we became the key M&A team for that particular company, or we became the key strategy consultants for them, telling them exactly what to do. And I think that is the partnership that you need to look for. And that truly is the value add that private equity brings. What has happened in India is that in most cases, the owner or the promoter just looks at private equity as another source of capital and not necessarily as what else can they bring to help me improve my company and get it from one inflection point to the other. And I think that truly, what you said, is what we can do.
Yeah, I mean, just add, I think in some of our experience, we find that before you get the money, we are a facilitator, and after you get the money, we are the intruder. So that's another problem that we have.
So let me move to, we have in the audience Keshav Murugesh, CEO of WNS, which is one of the most successful BPO companies out of India. Keshav, your thoughts. Would you go in for private equity? Would you go in from one of the gentlemen on the panel here? And if so, on what terms? We've seen last year the largest private equity deal done in India was in a competitor of yours. So what are your thoughts as a potential investee company?
Great question, Srivatsa. First of all, I must congratulate all of you. Great panel discussion. But I must say, you have a star cast, but the star story has still not been told. There's a lot hidden yet, in my view. I must confess that as of this morning, I have just, exited my private equity firm. So I just want to say that, whereas I think we spent a lot of time on the negatives of this country and of the opportunity generally, I think there's a lot that is also possible if you go beyond that, focus on a business model and really back good governance and good management. I think that has worked. And in my last 10 years, I've seen that with the last two companies I was with, in the worst economic climate, we actually grew market cap dramatically, and we returned capital wherever it was required. And I must also say that even with this company, WNS, even 3 years ago, every private equity firm actually said it was not worth investing in. And today, Warburg Pincus is sitting happy, with having made close to $600 or $700 million. I think about $200 million as of yesterday. So I think, PE makes a lot of sense based on where the company is. But my advice is really back good management and good governance.
And given that my good friend Nitin Malhan isn't here, let me ask you, take the liberty of asking you, are you happy with the investment and the value add that the private equity investor has brought to you as a company?
Always. I think private equity should really focus on investing and managing at a governance level, not really get involved in the business day to day. I think as long as you're backing good management, the rest is done. The mistake you sometimes see is, bringing in battalions of accountants, thinking based on a spreadsheet model you can run a company. It doesn't work.
Right. Just seconding what Keshav said, I think at least my experience has been the best investments are those where you're least involved with management, right? Because if you're backing a team, they run the company, right? I think you have to identify where you can identify strategic input versus if you try to, that's why a lot of people, except for Akhil, a lot of people who are operators before don't become good private equity investors because they actually tend to get very involved with investing. I think you're one of the, I think unique examples of people who've actually done it successfully.
Any other question? Yes.
Yeah.
I'm Shekhar Rao from a company called Juno Tele. I resonate what Keshu was saying, the star studded, but the star story is still down. And when you said Sholay on a lighter side, I was just looking who is going to be the Gabbar Singh in this. But we didn't hear anybody out there. Okay.
That's true.
Yeah. On the serious note, the question to everybody on the panel, now, the Indian companies that's getting global, and for the reason of the from the investors' requirements to get a better corporate governance, moving to the first world countries for that. How do the private equity companies out of India, would you support those growth in the outside market? Like if my company is getting now into the Asia Pac, so would you guys guide us to the Asia Pac counterparts of yours, or would you take it from here and to the investments in this company?
Question to whom specifically?
To the whole group, because all PE, the questions to all the PEs.
Let me give it to Neeraj.
Yeah, no, I think, as I mentioned earlier, one of our themes is backing Indian companies to acquire globally. I mean, I think Sandeep said earlier, there's a very large cash pile which Indian companies have, and frankly, some of the investments you can make abroad look better from a risk-return perspective. I think the sort of three things we focus on. One is we have a very broad network. So Carlyle is in sort of most geographies. We have about 70 different funds. So we have a very strong global footprint. So we're able to make introductions. I think a lot of times we do focus on what is the strategic rationale for an acquisition, right? India went through this time period in 08, 09, where just making a global acquisition, regardless of what the strategic merit was, made sense. So I think we've actually tried to work with consumer goods companies, potentially some people on the IT side, where there's a rationale for an acquisition. I think thirdly, there's been no history of global acquisitions in India. I mean, there have been a few, but sort of post-merger integration, how do you give equity to your management team, which is sitting in Germany? How do you actually compress the return time frame to 5 years versus 15 years? I think that there's a lot still to be done here. So, my experience has been that Indian companies doing global acquisition is actually, they're very naive at this point in time. And so we as private equity investors with a global footprint can bring a lot to bear with the right partners.
Okay, I think we're standing between all of you and lunch. I started with Sholay, and I'd like to end with my favorite television serial in the world, which is Yes, Prime Minister. Those of you who remember Yes, Prime Minister, in the first episode of season 1, there's a hunt on for the new Prime Minister. And Jim Hacker, who's one of the contenders, is asked, and he goes around asking everyone who's a contender for the throne denies that he's a contender. And his wise principal secretary, the IAS officer of UK in that case, Humphrey Appleby, tells him that Prime Minister, all those who deny that they are in the running for the Prime Minister's job are the ones who are on top of the race at that time. I have on this panel many of those who asked me that why am I on such a star-studded panel? I shouldn't be there at all. So I was trying to make a larger point that each one of them is a potential prime ministerial candidate in the private equity industry. It's a great privilege for me to host this panel. I'm personally grateful to every one of them for having agreed and accepted my invitation, especially to Sandeep, who did so at 2 hours' notice to stand in for someone who had fallen ill, to Arun Natarajan and Arihant of Venture Intelligence for hosting us so generously, CNBC, Outlook Business for making this happen along with us as partners, and last but not the least, such a wonderful audience, without all of whom this would not have been half as fun and exciting. Thank you very much for being here. I'm so grateful to all of you. Thanks a lot. Thanks.
Thank you very much, Mr. Srivatsa and all the panelists. It is indeed a very superb session, and you have provided a lot of food for thought.